oil up again. Headlines saying that we may be closer to a major Middle Eastern conflict than most Americans realize. What's going on in here in these oil markets? We'll take a look at this right now. I'm Patrick Ceresna, and I give these macro outlook updates every morning, Monday through Thursday. So if you're loving this, make us part of your morning routine. All right, let's dive into the charts and look at crude oil. Now, I want to simply highlight here that crude oil has been like the honey badger. Every time they throw bad news at it, it just like don't give a shit. Just quickly gets bought on dip almost right away. Overall, all year, that's been the story I've been talking about on this channel for since the start of the year. We basically have had a period where every time this bad news, it gets bought on dip. Bad news, bought on dip. The price action, it's been now over a month where it's been trading above its 50-day moving average. Everything's always been held to retracement zones. And even just like over the last couple of days, oil markets weaken, boom, they come right back up. Overall, the price action is still quite accumulative, and yet most people are actually quite structurally bearish oil. And I find this to be super interesting. It's like whenever you have a scenario where the market price action is telling a different story than what is broad consensus. And what is broad consensus is that Trump needs low oil prices for the midterms. This is a very consensus view. And so it's an interesting scenario because obviously, there's a lot of pressure from, I don't want to get too deep into politics, but there's a lot of pressure from Israel to deal with Iran. And at the same time, you have a scenario where Trump wants to stay restrained because of their own political pressures back in the United States. So is there going to be an escalation? Well, I don't think oil needs an actual conflict to go higher. It just needs the escalation of the conflict towards war to go higher. And I think that is definitely a good possibility because in the end, in order to even get to a good negotiation position, the threat of war has to be very real, even if it doesn't actually end up seeing any kinetic war actually begin. So will there be more oil upside? Well, one thing for certain is that in spite of what everyone else is thinking, the oil markets from volatility and from the option skews is pricing in a very heavy right tail. It is not common to see this. We've seen it in gold and silver before, but a fat right tail, or even in treasuries, but to see it in crude oil to this steepness is not often that you'll see it. What does this mean when you look at this? Well, it means that all of the out-of-the-money call options, all of the speculators speculating on $85, $90, $95, $100 barrel of oil, these call options are commanding large implied volatility premiums. Basically, they're not giving these call options away for free. They're making people pay up on them. This is super interesting because when you see that, it actually allows you to build lots of convexity in option structures to play that upside with a small capital outlay and have that right tail upside. I do want to put some perspective, like a lot of people are even skeptical that we can even get a push to $70. But I want to highlight, when I go on a weekly chart and really zoom out, the last time crude oil had an escalation, which was the Ukraine conflict, prior to the start of the conflict, before it even began, crude oil went from 60 some odd dollars to 120 some odd dollars on the upside, just in anticipation of that. So like when we're talking about a potential rise in oil to 70 or even $80 here, it's when you put that in comparison, there's a lot of right tail moves that can happen on crude oil the markets are simply not pricing in. At this point, I'm not trying to say that with certainty that a big upside move is imminent, but I will certainly say that the options market is commanding some big vol premiums on betting on that right tail, and the price action of oil is showing for certain some accumulative patterns of being bought on dip and almost all selling very quickly, being blunted and contained to very natural retracements. Overall, the price action is quite distinctly bullish in this way. And what's interesting is a lot of energy stocks and other things, like, for instance, I'm just going to type in the XLE, which is the major oil companies, have been on a tear and have been one of the places where that sector rotation we talked about over the last few days is actually having money put to work. Will this continue? Well, certainly at this stage, I think further upside on crude oil is certainly the path of least resistance in what is now the new short-term prevailing trend. And we're going to see whether the bulls can continue that. I want to briefly just touch on the stock markets. Before I do, I just want to talk about gold. Gold is in the meat grinder. What I mean by that is that we had a huge bull market. We had a blow off top, which was something that we expected. And now there's going to be a period where gold needs to settle down. That doesn't make it bearish, and it doesn't make it short-term bullish. What you have to anticipate is getting just bounced around between support resistance is very likely the highest probability for how the first quarter of the year will play out. I still actually think it's a very reasonable chance that the low at 4,500 that gold put in during the crash sequence may end up being low. So it's not like there's a big downside risk, but at the same time, how much do you want to grind out sideways price action for months? At least for long-term holders, it's not so bad. On short-term traders, it might get you chewed up a little bit on trying to time that out. Let's quickly talk on the stock market. It walked to the edge of the cliff, that 6,800 line we talked about, and backed off of it. But this has not been an impressive bounce. I mean, overall, software stocks are structurally weak. The Mag 7s are structurally weak. Financials, just a very modest bounce. We have not seen a pivot. I want to highlight that it is very reasonable to assume that with a huge option expiration in February coming up here on Friday, that may keep the markets pinned in a gamma pinned into this kind of tighter range. And that really next week, driven by NVIDIA's earnings, could be the next kind of real volatile moment. So, even though the story is still the same, it doesn't necessarily mean it has to happen right away. And that, I think, is a very important thing for all of you to take away. So this is where we'll wrap it for today's session. I'm just going to be jumping on with my Big Picture Trading members into our live webinar where we take all of these ideas and we put them into trades and do that. So if anyone wants to see how we're doing this and how we're constructing all of our trades, you can go to Big Picture Trading. You can try the free trial through clicking the link in the chat, or just simply go to bigpicturetrading.com and register for the free trial. When you get into the member section, there's a big orange button that that says join now under the where's the trade, and you can come in and join the live webinar where we're going to be continue talking about these markets and the opportunities. Thanks everyone for joining me. Have a great trading day. Otherwise, we'll be online again tomorrow morning to give you another update. Cheers.